So I have a few questions. They're really good questions, and I could probably talk quite a long time on some of them, but I'm going to try not to. I'm going to do the easy one first, and that is when our office distributes the monthly Cadget money, certified shares, and PTR, are we to send them the monthly amount and list it as a lump sum only on the Form 22? And I'll stop there and say yes. It's just a single amount. And then they go on to ask, do we need to calculate the breakdown of the total into individual fund of each individual taxing unit? And that answer is no. And they go on and say, the example, the taxing unit receives $2,000 per month. Has a general fund and an assistance fund. Do I need to create an allocation factor? No. And determine how much of the $2,000 goes to general and how much goes to the assistance? No. Or simply send them the $2,000 and let the taxing unit determine where it goes in what amounts. And the answer, that last part of their question, the answer is yes. The unit determines what fund that it goes into. The allocation of the Cadget and the COIT certified shares money that allocation isn't based upon property tax rates. That allocation is based on what decision the unit made at budget time on which fund or funds they're going to put that money in. So you would just simply send a Form 22 with the single amount listed. Please do list it as Cadget if it's Cadget, and certified shares if it's certified shares, and PTR. You do need to separate PTR and certified shares for those Cadget counties. COIT, there is only certified shares, but you do need to label on the Form 22 that it is Cadget, or in the case of COIT, and seated if it's seated. You need to label it accordingly. And then for the Cadget, separate it, certified shares and PTR. I'm trying to decide which one of these the other questions all deal with the ineligible homestead credit, and if the auditor chooses to remove homestead next year due to no pink form return, do we charge homestead fraud percentage for 1 year or anything? If you're removing it solely on the basis of not receiving the pink form, the answer is no, because the civil penalty, which this writer refers to as the fraud penalty, but the civil penalty is applicable when you're removing the homestead because there was a change in the use of the property, or if the taxpayer was receiving a homestead or standard deduction on more than one property. If they become ineligible for it for those either one of those reasons, then the civil penalty charging and going back for the 3 years, if the 3 years are applicable, you only do that in those instances where there was a change in use of property, or the taxpayer was receiving the deduction or the benefit of the deduction on more than one parcel. If you're just removing it because they didn't file the pink form but otherwise are eligible, then they don't qualify for that ineligible homestead provision. So that kind of separates. Now, if they didn't file the pink form and they also aren't eligible for it because they are receiving more than one deduction, or there was a change in their use of the property in the year, in the recent years, then they would become eligible for that civil penalty and that. But so it's if it's just simply because they didn't file the pink form. I had another comment, but I think I'm going to wait on that one just for a moment here. Actually, I think I'll go to this question. Dan said, we believe this is the question that Janie lost because it began that way. And when you read that, you think, oh, my Lord, what did I say? And how did I say it wrong? Or how did I say it in such a way that they're confused? But in a personal email, that the ineligible homestead, when unpaid to the auditor, was to be added in the spring/fall tax bill, and I'm not really sure what they mean by spring/fall. Is it spring or fall, or I don't know. But anyway, example: if a 30-day letter goes out of County Auditor's Office 8/23 for 30-day collection by 9/23, the outstanding amount sits there from 9/23 until March 2013. Just mentioning for clarification, legislature, why 30 days? There is no incentive to pay in 30 days because there is no penalty. Well, the only email I can think of that I answered here fairly recently that this question may be tied to is, let me find this where it starts. And I look back on this email, and I may have not exactly understood the question. And if I did understand the question, I didn't count on my fingers and toes exactly correctly. But it said, Dan, I would like to know what we should do on ineligible homesteads which were levied 9/20/12 to the taxpayer. If unpaid, will they be added this fall or next spring? The ones we did earlier this year prior to spring were added to the spring taxes. But how do we handle those levied this fall prior to fall collection? And now think, you know, when you rethink something, how you should have answered this, I really should have answered this simply by saying the same way you did it in the spring. But no, I have to put a few more words to that. And so I said levied 9/20/12. I assume you mean a county auditor bill was issued. If my assumption is correct, then after 10/20, you could add them to this fall, but they would not be eligible for fall late payment penalty. Therefore, I would add them next spring. Well, I miscounted my 15 days. And so I was off a few days there, and that may be the confusion with that. But this area was addressed back. I actually had a presentation at the Spring 2011 conference on the taxes and penalties on ineligible homestead credit. And I intended to ask you too about this a moment ago, forgot. When I went out there to find this presentation on the Board of Accounts website, I didn't find anything for Spring 2011 conference for some reason. But it just so happens I repeated this presentation at the Treasurers Conference in August of 2011, and it's identical presentation as the auditors. So if you go to the Board of Accounts website and to the County Treasurers Conference, August 2011, and look for my taxes and penalties on ineligible homestead credit presentation, and you go to that and you look at slides, I believe it's 14, but let's get there. The 14 and 15 are two slides where I discuss this situation where I say, if not collected in full within 30 days of county auditor's notice, then The uncollected additional tax and civil penalty is added to a separate section of the tax duplicate special assessment section. Suggested title is of this separate section would be ineligible standard deduction. Slide 15, I go on to say the amount added to the ineligible standard deduction section of the tax duplicate is collected in the same manner as other property taxes. It's collected by the county treasurer. Tax statement is issued, and it's eligible for late payment penalties at the next regularly scheduled tax due date if the next tax due date is at least 15 days after the tax statement is issued. And also, I have a bullet here stating that the non-payment can cause property to be eligible for tax sale, which kind of gets me into my next question here in a moment. Also, on slides 20 and 21, I have some more about that once the unpaid additional tax and civil penalty is added to the ineligible standard deduction section of the tax duplicate and billed on a tax statement, then the unpaid additional tax and civil penalty is eligible for late payment penalties. It's really just a repeat. And the late payment penalties are applied against the unpaid balance at each scheduled tax due date, unless the next scheduled tax due date is less than 15 days after the unpaid tax and penalty is added to the tax duplicate. So all those same penalty rules are applying here. If you're billing on the tax statement, once you've not collected it and it goes over to the treasurer collection process and goes out, then the 15-day requirement is in place. And so if you're 15 days or less on when that tax statement gets out, then you can't charge a penalty at that next tax due date. It'll have to be the following tax due date. My thinking is if you have a situation like that, make life easier and just not put it on the tax duplicate until you've rolled forward, because you can't charge a penalty if they don't pay it anyway. And that was my point with saying I'd just wait till you created next year's tax duplicate. But I was 5 days off on my 15 days. But I'm gonna try to convince you to think that my thinking was that you won't get that tax statement out in 5 days. But anyway, but it is subject to the late payment penalty, and you should put those on as soon as the 30-day period has lapsed, unless it is going to be 15 days or less before that next tax due date. And but that's your choice. You want to go ahead and put it on there and flag it not to charge penalties, that's good too. But you can't charge the penalty unless they've been given 15 days or more notice, or more than 15 days notice, I should say. Now I've buried the question. There was another part of this. Legislature, why 30 days? I think I even mentioned that in my response here. Like I said, I got much more wordy in this email than I needed to be. I just simply should have said, just do it like you did in the spring, and I wouldn't have to be up here being embarrassed by the fact I couldn't count 15 days. But anyway, and the auditor then said that is what I thought. It then would keep the ineligible ones on the same schedule, and I should have been able to read into that response that I didn't communicate very well, because I can tell now by that response that this auditor is thinking that they should only put them on in the spring, and that's not the case. That is not the case at all. Then it go on to say taxpayer benefits, because they really get more than 30 days to pay, and can take that long if they choose. And and wonder what the incentive would be to pay in 30 days. And thinking of the legislature, I should have understood from that response that I didn't communicate very well there. But I went on to say, though, I told the auditor that I really don't understand the 30-day part of the legislature also. I don't know where that came from. I have no idea where that came from. But it's there. It is one of the requirements for the 30 days. And hopefully I cleared that up a little bit, didn't make it more confusing. If I made it more confusing, you can call me or email me. Okay, on the ineligible homestead, if a property is sold and previous owner owns another home in county or elsewhere, do we have any other recourse to collect previous years? There's a few things got to make assumptions here. I'm assuming that this question that that this previous owner owned another home while at the same time they owned that home that was sold that they were getting a homestead on. The fact that they've sold it and now they've got another home and getting a home, that's not a problem, getting a homestead. But if they had both at the same time, then that's where they're not eligible and they're subject to this ineligible homestead statutes and the back taxes and the civil penalty. But one part of my answer here is that answer you never like to hear, but you really need to consult your attorney on this. This is one of those problems going after trying to enforce an ineligible homestead situation after the ownership has changed. Those taxes and penalties that you put on there, they follow the property. And real estate taxes follow property. Personal property follows the person, but real estate follows the property. And so those back taxes and civil penalties that you would put on there, that's actually a lien on that property. And now you have someone other than the person who was guilty of the ineligible homestead filing. You got the new owner. They didn't have anything to do with that. But they're the person that's on the record. They're the person to get the bill and all that. And if you follow that all the way through tax sale, they're going to be the one that's going to have the consequences of the property selling on tax sale. So there's all kinds of problems with trying to enforce ineligible homesteads because of actions by someone other than the current owner. And so your attorney needs to know that that's your policy. You're going to go after it regardless. And they need to know and be with you because, this could develop into some legal matters down the road. And you need to make sure they're with you that, okay, we're going to do this. But that's something you really, really seriously got to think about. I understand your frustration. I understand you're wanting to do it. I understand that you can do it. But you really got to go carefully here with this. But is there, the recourse? Yes, the recourse is tax sale. But you gotta think about that. And do you want to do that? And do you want to? The only way it's going to stay off tax sale is if someone pays it. I mean, the current owner may decide that it's worth paying those taxes, but or they may some miracle convince the prior owner to help them pay it, or somebody will pay it, or the mortgage company will pay it, and then the current owner is going to pay it. But anyway, you just really got to think that through. One thing I wanted to kind of throw out there this morning, this wasn't really in part of the questions, but the struggling with these pink forms and removing tax or removing standard deductions and if applicable the homestead credit and the removal of those standard deductions. That particular statute does say 1 year or assessments after January 2012, which makes it 2013. A thought I had about that is, you're talking about putting it on, changing it on the duplicate and then finding out that they really were entitled to it, and you got to change all that stuff. Something you might want to think about from an administrative standpoint is just putting on those back taxes as an additional charge just for that, and not touch what's on the duplicate, and then you would touch what's on the duplicate for pay 2014, and then you leave that 2013 tax bill on the duplicate just as it is, and you got this other back tax charge for that year out here as an additional charge. And then if you find that you shouldn't have charged that, then you can just wipe off that additional charge, and you've never touched the duplicate, and it may be administratively more, maybe easier. But on the other hand, there may be constraints with doing that with your systems. I don't know, but on the ineligible homestead credit, folks, where you're charging the 3 years back taxes and the civil penalties and all that, and that you're discovering now, there again, I wouldn't touch that 2012 pay 2013 bill. I would put on the back taxes. I would include the 2013 taxes, the 2012 and the 2011, and charge the 10%. That would be your county auditor notice and your billing that goes out. You don't touch that tax duplicate. You don't have to touch that because you got that bill out there for them to pay, and then you're getting all those other taxes with this county auditor billing, and then the maintenance that you do on your system is going to be going forward for pay 2014. But just some thoughts I had about trying to administer that. And yes.
Guys get that? Okay.
I didn't like it.
I thought it was ingenious, Dan. No, I thought it was an important thing to think about because of the danger in sending in more net AV and affecting your rates, and then finding out that the deductions really should have been allowed and they weren't ineligible. It was just that they didn't return the pink form, and really ending up with some rates that you were unhappy with. So it's something you have to think about and definitely work with your vendors. And so I thought it was important.
Let it sink in.
Good information, Dan. Thank you.
But yeah, it's a way just to keep the net AV, not be touching that, and letting all that homestead business work itself through. And I think that was it, wasn't it? Yeah. I've shuffled these papers blooming many times, but I don't know if I hit any. Sorry I took so much time. So thank you for having me. Have a safe trip home. Hopefully I see you. I know I won't see all of you next spring. That's not very that's sad. Because you develop, while we don't get to see each other very often, you still develop, I think, some friendships and so best of luck for those who are moving on to bigger and better things. There has to be something bigger and better than this. But personally, I think it's an exciting job you have and a very, very, very important job you have. A good, strong county auditor is a tremendous asset to a county, and you all work hard to be good county auditors. So have a safe trip home.
Thank you, Dan. We really appreciate everything you do for us. I know the county auditors do. Very much appreciate you, and thank you for being here this week. And before I get on with my questions and everything, I just want to say very shortly again, thank you all for coming here, for being here, for participating, for having a good time in the evening. I take it last night went well and that it was a good time for you all? Yes? Okay, good. Because that's part of it. That really is part of what these conferences are about. It's not just the training in the day, though that's very important. It's also for you all to be able to get together, get to know each other, feel the part of the community that you really are in. And I know that Tammy and I just so appreciate what you do every single day, and we will miss those that will be leaving us, but good luck to you on everything. And again, Angie, I just can't say enough for you and your association. It has just been a wonderful, wonderful conference, so thank you very much. Okay, I'm trying to see the questions at the same time. This thing's in my way. Okay, good. Should deputy coroners who make $125 per call be paid through payroll or claims? Compensation for county employees, and I believe that most of the time they would be, but compensation for county employees are through payroll, always. Board members, should board members be paid through payroll or claims? This can be a little tricky here, and I really hate to throw it off this way, but this issue has been raised before, and the IRS has brought some exceptions depending on the board member, the per diem, what's going on. So it does depend, so you need to go to the IRS 15, and it's just really going to depend on the situation, but you want to look at contractors versus employees, go through the checklist, make a determination, and then if you're still just unsure of what to do, I would contact the IRS, contact Raylene, because she's very familiar with local units and their boards. Which elected official is responsible for the elected officials training fund 1217? We've had questions about this. Right now, the county council appropriates it. So, responsible, well, it's just going to be one of those things until they get a grasp of the funding, how much is needed, what's going to go on with that the county council is just going to have to figure out how to properly appropriate it. Our prosecutor has decided to stop a local town court from handling traffic violation tickets, which triples the work for the clerk's office. I imagine so. Due to the people in the clerk's office having time off for surgeries this year, there is leftover wages in her line item budget. Can those extra wages be encumbered to go toward the extra wages needed for 2013? Remember, there's limitations on appropriations being carried forward. They would be for a contract that has not been fully paid, purchase orders issued on or before December 31, proceeds of a bond issue appropriated and unexpended, any appropriated funds for wages that are unexpended at year end would revert and would need to be reappropriated. And this would be except for wages earned in 2012 and paid in 2013. If a person is appointed to fulfill an auditor's term and her daughter was already employed in the auditor's office, is she grandfathered in? Will she need to quit in 2 years when if her mother is elected auditor? Okay. IC 31-1-20.2-2, an employee who is employed by a unit on July 1, 2012 is not subject to this chapter unless the individual has a break in employment. So, let's see. IC 36-1-20.2-11 applies to an individual who is employed by a unit on the date the individual's relative begins serving a term of an elected office at the unit and is not grandfathered in. Unless a policy adopted under Section 9 of this chapter provides otherwise, an individual remains employed by a unit and maintains position even if it would violate Section 10. So it does depend on what timing that they've been employed. It's going to depend on what the position is because it's the direct line of supervision issue. We would always recommend, because employment is very important. It's important for the person involved, obviously, and it's important as far as potential lawsuits to the county. So we would always recommend that you look to your county's policy and that if you have concerns that you contact your county attorney. DLGF instructional meetings. Let's back to the travel. Is payment to be made from appropriation or unappropriated? So it would be unappropriated general fund. Court costs due towns. I request documentation from the towns that they have prosecuted 50% or more of their ordinance violations. None of the towns have responded. Do I just keep that money in the fund until they do respond? And the answer to that is yes. That is separate money that's due to a local unit. We have a county health insurance fund. We quietus our health premiums paid by the county and by the employees into this fund. When we receive expenses for health care costs, they are paid from this fund. Should the expenses in this fund be appropriated? Another simple answer, yes. I have several funds that revert to county general at year end. Do I need to appropriate a fictitious amount prior to year end in order to not get written up for an overdrawn appropriation? You really shouldn't get into this position to begin with. Remember, to expend money, you must have both the permission to spend through appropriation and the funds to cover it. Under IC 36-2-9-13, states in part, the auditor shall keep a separate account for each item of appropriation made by the county fiscal body, and in each warrant he draws on the county treasurer, he shall specifically indicate which the item of appropriation the warrant is drawn against. The auditor may not permit an item of appropriation to be overdrawn or to be drawn on for a purpose other than the specific purpose for which it was made. If commissioners set the amount of the per diem, may the sheriff pay a greater amount Our sheriff has line items in the budget he uses to pay per diem each mileage. The county per diem is 26, his is 35. If it's in your county policy, that could occur if you want to set up some different per diem rates. Otherwise, there would need to be a statutory authority, such as with called meetings, which we've discussed. I'm not aware of anything separate for sheriffs. If deduction forms are scanned and stored electronically, is it necessary to keep a paper copy? Yeah. We couldn't find anything where the original documentation that you could destroy it. The Commission for Public Records, in the public records retention for this kind of document, it's that you destroy 3 years after the property's sold or the person has died. I mean, this could be 100. You know, some people do live a long, long time, and so this property could be for quite a while. So, for destruction of this property. The Public Records Commission does have a policy, which is number 12-01. It does refer to the Uniform Electronic Transaction Act, which is IC 26-2-8-102, and it gets into the reliability, integrity, usability, and authenticity of those records. Scanned records can have limited life viability, so there would be that issue. They also have a policy in 06-1, which is the acceptability of electronic media in lieu of paper. If you really have questions on this, I would contact the Public Records Commission about this, but we couldn't find anything. Okay, for the Uniform Electronic Transaction Act, that's IC 26-2-8-102. Is there a statute stating mileage claims are to be turned in whenever a certain amount, turned in within a certain amount of time? If not, can the county council adopt an ordinance? Our council adopted an ordinance that mileage claims have to be turned in within 30 days of travel. Commissioners don't think the council can adopt the ordinance. Statutorily, no, there is nothing for a time limit. I always kind of hate to answer a question like this, but you know, the county council and commissioners, it'd be great if they would work together. When there's a question as to whose authority is being stepped on or not stepped on, that really needs to go over to your county attorney and let them work with those two bodies to see who has the proper authority. Okay, well, I'm going to turn it over to Tammy, and got just a few more, and then we'll release you. Thank you very much.
Good morning. I agree with all that Debbie said about thanking you for being here, thanking your association's officers for doing all that they do to make sure that we have fun and are comfortable at these meetings. And I'd also like to thank our host county this week, Marion County, for their participation and their officials showing up to greet us each morning. That has been nice. I do have just a few questions, and I'm going to start off with the ones that were on the ineligible homestead credits that were on the part asking questions regarding the use of the fund, which is what I wanted to talk about yesterday, or day before, and I should have stuck with that. As Dan said, he should have stuck with do it like you did the spring. Well, I should have stuck with just that because I think I did misstate one thing, and it'll come out in these questions. But I understand it also did stir up a lot of things that were presented in Dan's presentation. We've only kept the auditor's conference materials on our website for the 1 year, but do remember you have the auditor's website you can go back to, and you can see those presentations, you can get the materials, and certainly if you can't get the 2011 presentation that Dan did give you in the spring of 2011 on ineligible homesteads, I would recommend you go back and ask us for the materials. We'll get it, because I revisited that as a starting point for my presentation, and it is a good presentation to look at when you get ready to start handling some of these. First question, what happens if council refuses to appropriate ineligible homestead credit money? If the council refuses to appropriate it, you will not have permission to spend from that fund. And the monies will just sit there until some auditor has permission to spend that money and there's cash balance. Can an employee be hired out of the ineligible homestead credit money? Yes, personal services for the county auditor's office is an allowable expense from the auditor's ineligible deductions fund, and you would be allowed to use it for that purpose if it was appropriated for that purpose. Do keep in mind, whenever you pay for an employee, that that position needs to be included in the salary ordinance. Tammy said, I went, uh-oh. If you determine it has been over 6 months and a homeowner has not notified the county of the change, a new tax bill will be sent with the 10% penalty. Please clarify. It was my opinion the 10% penalty was put on for prior years, 10 pay 11, 9 pay 10, 8 pay 9, not 11 pay 12. Dan's presentation does a really good job of getting into exactly the timing of all those penalties. But I will say that I did misstate, and here's where I made my mistake. The Indiana code on this area is IC 6-1.1-12-37F as in Frank. And it requires an individual that has a standard deduction but is no longer eligible for the deduction because they've changed their use of the property, or they had more than one standard deduction on more than one property, then they have to submit to the county auditor a certified statement, and it is not 6 months, it's within 60 days after the change in use or the fact that they got in a different homestead property. So I misspoke, it is not 6 months, it's 60 days. But as far as penalties, I think what we were talking about yesterday was the civil penalty, which is different than the late payment penalty. So I did not mean to reopen old confusion about late payment penalty. That is not the case. You are going to calculate what they should have paid in taxes and the civil penalty, and you are going to send them that statement to be paid within the 30 days. But do go back and revisit Dan's presentation on doing that, because it has all the specific instructions, and it does include how the late payment penalty also fits into this circle. On the chart of accounts, I have a number of funds that have been closed, dormant funds, completed grants. Do I need to give them a new fund number for the chart of accounts, or can they stay with their old 3-digit fund numbers? These funds will be shown on my 2012 annual financial report, but won't be used again. And this is the part of the question that I really, I failed to advise you very well on this. I think we did a good job of, during the conversion, cleaning up a lot of dormant funds. But at that time, I had no idea how the annual financial report was going to work. But I am pleased that you will have the option to either report your 2012 information on the new chart of accounts, or you may stick with your old if you do not convert until 2013, or you have half years and you don't want to deal with that. And so it depends on how you choose to report on the annual financial report. If you choose to report using the new chart of accounts, you will have to give those dormant funds that had activity or a balance in 2012 a new fund number. It will be a custom fund number, and 2012 will be the last year you report those on your annual financial report. But it will have to be reported until it has no activity in the year and it has a zero balance. If a county has a fund in their old chart of accounts that will not be used in the future, but there is a balance in the fund, will a custom number need to be set up in their new chart of accounts? Once again, yes, if you're using your new chart of accounts to report in the annual financial report, you will have to give it one. If you choose to report on the old, you won't. What about for historic purposes? If a county had a CUM fund in 2012 that was done away with, et cetera, will these need a fund number set up in their new chart, even though the fund balance is zero? Like we said, in the year that the fund balance goes to zero, that will most likely be your last year of reporting unless you have some activity in future years. I have a grant that will require a grant match. The match will come out of the Riverboat Fund. Do I put the match money in the grant fund? The answer is yes. And so each claim, if it's a 80% federal, 20% local match grant, you're going to put your 20% of the grant, of the total grant in the grant fund, along with the federal dollars that you get. When you close it out, so every disbursement is basically has that 80-20 split. It's an assumption, an accounting assumption that we make. And so in the end, the remaining balance has that same 80-20 split. So if there's a remaining balance and you either don't claim it or you send some money back to the feds, you're going to keep 20% of the balance and put that money back into the Riverboat Fund where you took it. Does the Women, Infants, Children grant, a reimbursable grant, require appropriation? The answer is yes. Reimbursements received would require appropriation to be spent. Advance grants do not have to have appropriation if they have a budgeted amount within the grant agreement that you can post from. I have set up a new WIC fund with the new chart of accounts. My old fund, number 269, won't be in use in 2013. Do I need to give Fund 269 a new number? Once again, if there's no activity or balances, then you do not have to report it anywhere, and so you will not give it a new fund number. But in 2012, you may have to. Court costs for cities and towns. In a 6-month period, only one city prosecutes. Do they receive 100% of the court costs for cities and towns? And the answer is yes. It can be a windfall for just one unit of government. If they are the only one that qualifies, they get all of the money. Is there something we need to do to keep it segregated by who files what violations? No, you do not have to keep it separated. You will look at it at one point in time each 6 months. It's a snapshot. At that point, whoever qualifies, if you have any that qualify, those municipalities, you go through the process of using the formula to allocate the funds, and you won't look at it again for 6 months. You'll just make deposits until 6 months later when it's time to distribute again, and we'll look at another snapshot. What does the State Board of Accounts stand on poll workers as employees? Won't that screw up the annual reports to have them as employees? The annual reports that you submit, including the 100R report, really should reflect your records. So some poll workers that are county employees have to be given that treatment as employees, even if some of their pay for the days they work the polls is exempt from taxation. But they're still employees, and they should be on the 100R. Other people just come and work the polls, and that's all they do for the county. They are not employees, not considered employees for treatment under the IRS rules. If that's the case, that you've gone through the rules and they're not employees, then you do not report them. So either way, I don't think you're going to mess up your annual report or your 100R. The most important thing is to give them the proper treatment under the IRS guidelines. Could we have a session on budgets at the spring conference? Those who already know it can go shopping or take a nap. But some of us would love to have a course on the start to finish process. Explain who has to submit through and binding and non-binding, what forms should balance or add up, zero out. We can proof our submissions through Gateway. We will recommend this. We have a meeting each year with your officers in Tim Berry's office with the DLGF, the Auditor of State's office, and us, and we do a lot of planning for the next year's education for you. And your association for the last several presidents has been very active about doing this, and I'm happy to see that it has been carried on by all of the officers since that time. And so December 6th is the date we're going to meet in Tim's office, and we will definitely take this recommendation with us at that time. I will say naps and shopping will not be allowed at a state called meeting, and that is on camera. Now, do keep in mind, it may come out of that we want to do something at a district or regional meeting. Maybe they want to revamp their own budget workshops to do something like this specifically for you, so that not everyone has to come up with something else to do if they already are very familiar with the process. Do remember that eyes are watching you at all times. You know, that media person that comes in our office and looks at every audit report and sees who's reported a theft or a fraud or a shortage or a loss that you've had, and if they see it in the paper before you've reported it to us, they're upset and they're reporting that you didn't do what you were supposed to do. Well, those same kinds of people have a job to watch us all as we come to these things, and I'm happy to say that you guys do a great job of participating. When you know you need to be in the room, you are, and you're all adults and very professional, and we appreciate that you are that way. And I know it. I know that this person is just concerned that maybe not everyone needs that type of training, but trust me, there's probably more of you that do than don't. So it's not a bad idea to discuss how we could best present that material to you, and we'll certainly bring that up. Just a few more. Our Soil and Water Department told us at their conference they were told that the county should be running their stipends through our payroll system and take taxes out. Is this something we are really required to do, or can we continue to process through claims and issue a 1099? Debbie and I are in no way the IRS experts, but there are a few things we know can get you into trouble, and we want to make sure to tell you of those things. There are a couple of statutes that apply here, and that have to be, you're going to have to go back and look to see how these apply in this situation. But first, in the Soil and Water Statute, IC 1432-418 states that an employee of the district is considered to be an employee of the county, except an employee of a district whose position is funded entirely from sources outside the county. Soil and water employees are county employees, almost always. I don't know of a one that's not. But there could be. It could be that you have one that is a county employee and they have another employee that they fund. It's possible. But that brings us, if these people are county employees, Okay, that brings us to looking at these stipends that are being provided by the Soil and Water in addition to what we're paying them at the county. If we look at IC 36-2-7-2, it says the compensation fixed for county officers and employees under Title 36 is in full for all government services and in lieu of all fees, per diems, penalties, costs, interest, forfeitures, percentages, commissions, allowances, mileage, and other remuneration which shall be paid into the county general fund except allowable mileage, sheriff's meals, and tax warrants in some circumstances, and county assessor reassessment per diems. Those are the only exceptions. Everything else needs to be in the salary ordinance if we're paying it for compensation for duties that they are performing in their jobs as a county employee. That includes soil and water. So the county should pay the soil and water employee what is in the salary ordinance. There should be no additional stipends unless those stipends are getting paid into the county general fund from the soil and water. This person's a county employee, they're not entitled to it. Now, there is a way to work around this if the council agrees that they want these additional stipends to be paid, then they will have to include them in salary ordinance and enter into an interlocal agreement with the soil and water district to say, you are going to fund this portion of their compensation. We'll put it in the salary ordinance and we'll pay it out through payroll, but you're going to pay it over to us. So the county gets the money from soil and water, and the county pays the county employee that works for soil and water. Okay? So we need to make sure that those are in good shape. I know I've recently worked with the county to make sure that the commissioner secretary and the county auditor and everybody has worked really hard to try to get all the information and get it to county council who's struggled with this very similar situation. And I think that they're on the right track of not being happy with their options, but at least knowing that they have to keep the county out of trouble and they have to keep this employee out of trouble too. I mean, nobody wants to get an employee into a problem situation over just a little bit of money. Is there an Indiana code that says a deed has to have an acreage amount on it? If so, what is it? I did not find statutory requirements for the number of acres to be included in the deed itself, regardless of whether that was a deed that transferred property or it was a split or a combination. But I did find a statute that would enable the auditor in some situations to at least obtain that information, whether it's the auditor or the assessor that wants it. IC 32-21-2-13 applies when there is a transfer of less than the entire parcel or tract, so when you have a split. And it says the auditor may require a drawing or other reliable evidence of the number of acres, existence or absence of improvements, and the location of the parcel when transferring less than the whole tract. So that might give you the information you need when it is not on a deed. Last one. Please talk about any requirements for the auditor's office concerning the anti-nepotism statute pertaining to the DLGF budget orders and the SBOA verification process. There's three things that I think pertain to what you're talking about and maybe preventing you from getting budget orders. And that would be, first of all, the county's required to adopt a policy. Second, elected officers must certify by December 31st annually to the county executive that they are complying with the policy. So that the commissioners need to be setting up a process whereby they make sure that they are contacting each of the elected officers in the county and requesting that certification and then verifying that they're receiving that verification each year. And then the third thing is that the executive must certify that they have implemented a nepotism policy on the 100R form. And John talked about that when he presented what's going to be on the new 100R. There is a place that for the certification that you have implemented a nepotism policy and also a contracting policy. It does say, one of the things that John didn't get into is that it's the executive that has to make this certification, but it's you that have access to the gateway. So what we are expecting is that the executive needs to empower you to make that certification in the gateway for them. We are not going to give them passwords and user IDs in the gateway and try to get them to do it. We're more confident you will. So you will want some kind of documentation that they have empowered you to do that certification. Whether that's just a vote at a commissioners meeting that, yes, you know, county auditor, please make that certification. We do have a policy. We have implemented it. Do keep in mind that implementation is different than just adopting. Can't just adopt a policy, throw it on the shelf in the commissioner's office, and no one knows about it. That's not really implemented then. That's adoption. We expect a little bit more. We expect that the policy be disseminated and that you make other reasonable attempts at making sure people know of the policy and can comply with the policy. At the same time, we also realize that we've had an elected official here or there that take off for foreign lands in the winter, and you might not see them again till spring. Their office is running with their employees there, and they're not to be found. And what if they don't do that December 31st certification? Is that going to mean the county does not get a budget order? You know, so there's a difference between not having implemented a policy and made the attempts and monitoring that the elected officials did make their certifications and trying to get those certifications from everyone, and the fact that we have non-compliance by one person who just isn't going to get their certification done until they get back. So we will not be certifying to the DLGF that we found in an audit that there is non-compliance so that you don't get a budget order. We may take that to law enforcement officials and we may put it in the report that this person is not in compliance, but it is not going to keep you from getting a budget order. So those are the three things that could affect your budget orders. With that, I will say there were a few, maybe a dozen questions for the DLGF. I will be getting those to Catherine Wolter today, this afternoon when I return to the office, and I will make sure that they get those put into a FAQ document and out to you so that you'll have those answers. Most of them had to do with deductions, so if you had one of those questions, look in their documentation in the future for a response.